Hello, everyone, and welcome back to the J22 Report. I am your host, Johnnie Market. You all know that drill. Hit that like button and subscribe if you already haven't. And I just wanted to get into a video over the jobs reports numbers, just following up. I was talking about it. And the market, this is an interesting development based on what I saw, is that the jobs numbers, the job reports, that came in very robust, 275,000 jobs created. Now I can go into probably the quality of jobs or whatnot, but other people do that and show how it doesn't mean it actually means the economy's weak or why it's BS. I am not too worried about that personally. The market views it how it's going to view it. But what was interesting was the market, and I thought if there was a strong jobs report, the market would go up and they would talk about this sort of Goldilocks or soft landing narrative. And initially, I'm looking at the S&P 500. The jobs reports came in 9:30. Immediately on the open, it started going into positive. But then around 10 to 11 o'clock, it started declining. And it finally went into the negative around noon. And it stayed in the negative. It tried to attempt to get into the green, but then finished on the low. So the S&P 500 was down 33 points, a little bit over 33.6 or something around there. And I think what it is these strong jobs reports numbers, because they're using such fictitious numbers, counting, meaning revising them down so they can finish a good headline number. So I think the market is maybe catching on to that. And in order to pump that soft landing or Goldilocks narrative again, they're going to have to stop revising job numbers. Maybe they should, instead of revising the last one's jobs, they should actually count those as jobs lost. So the real number they should have reported, let me look, they revised I think 124,000. So why didn't they just they should have done 275,000 minus, I think it's like 124,000. Let's just say it's 124. I don't know exactly. Just at 151,000 jobs created. Well, that would have came in below expectations. That would have been a weak jobs number. And that is bad for the market. And that's probably what they should have done, how they reported it. And that way you wouldn't have to deal with all this revisions BS, and you can actually believe the headline numbers. And so I think the market didn't really believe the jobs numbers, because I was looking at it, and basically since 2023 in the beginning, they've been revising job numbers down every month. And it's been, 14 months or 15 months? And they've been revising it, and not just very little. Like, I'm looking at this article, Labor Department cuts 167,000 jobs from December and January's payrolls. That's a lot. And it said the Labor Department made, this is Barron's, this isn't like Zero Hedge or anything I'm reading. So, this is actually putting a positive spin on it. So it's not even, it's much worse than what I'm reading. So the Labor Department made significant reductions to previously reported outsized payroll gains in December and January. And you have to remember, in January, they already revised December down again. So it's not even, what they probably should have done is 275,000 minus 167,000. And what would that number have been? Just, if they wanted to do it fairly, 275. Just include the revisions in the jobs report for this month. That would have been 108,000. That would have came in way below expectations, and that would have been a jobs report. And that would have been, and so basically in the article, the department cut 124,000 payroll gains from the 335,000. So it was 100 initially reported for January. That was revised total 229. And you know what? They have to remember, it also cut 43,000 jobs total from the non-payroll gain in December, revising down its total to 290 from 333,000. And you have to remember, they revised down December's last month too. So they might even revise January's gains again. So I think the market sold off because it didn't believe this report. I think all these revisions, and if they want to do revisions, then they should just count them, subtract them from the jobs gained this month, and have a more honest headline number. But so they're really destroying their brand by revising all last month's jobs down. Just take the revisions and decrease them from this month's gain, and then maybe you're getting a more honest look. I mean, I don't think the numbers are even honest, including that. I think 0 jobs were gained this month. So anyway, and I can also tell by gold, because gold immediately sold off because everyone's thinking Goldilocks, soft landing. We don't need gold. We're just gonna buy the S&P and the Magnificent Seven, which is now maybe who knows, maybe the Fab 2 or the Fab 5, and gold went up significantly. I'm looking at the GLD because they don't have spot. Now the spot's just futures. But the thing is, gold went up and it finished up around $18 or $19 for the day. And that's not a good sign on a strong jobs report. So they're basically, and GDX even finished up 0.10, which wasn't much. So GDX outperformed the general equities, the S&P. Today it hasn't been outperforming. And so this is not a good sign. And these revisions, I always thought what might destroy the credibility of the jobs reports was, how they calculated it. But these revisions might be doing it, because now you don't know if they're going to revise, how much they're going to revise down, and it's going to be significant. So you can't even believe the headline number anymore. With all these revisions, you can't believe them. Now, if they were revising them up and there was a strong head number, that would be one thing. So yeah, in this article with Barron's, this is not Zero Hedge, the revisions shift overall picture of labor trends, making December, January far more in line with recent trends, but more reasonable at built strong. I don't know exactly. I'll post the article, you can read it. But they're trying to put a positive spin on it. It's mainstream. That's they're not telling the truth. So that's the other thing. The other thing I want to get into is reading this article on Yahoo Finance, and you can tell they're doing everything they can to prop up the powers that be, saying higher interest rates are good news for Americans eyeing retirement, with higher rates staying higher for longer. See, they're trying to prop up the subconscious thinking so they don't understand. They forget about higher interest rates killing asset prices, which that's basically most people's retirements, 401ks, home prices, home equity. Higher interest rates are not good for Americans retiring. But they go in these things with key investment rates, and they explain that basically higher rate of interest is helpful because you receive more interest income in CDs, cash equivalency, and emergency savings, which that's basically, they go into T-bills. And here's the reality is higher interest rates are going to lead to, we already see bank failures, but there's going to be in the next couple of years a major banking crisis where many banks and the FDIC, they won't be able to cover the losses. And that's why I always say, why do I love gold? Because I know it's coming. Now, I don't know if gold will perform well per se in nominal terms. A lot of gold propaganda, or the I guess, the gold grift group, the ones that always say gold does well in deflation. They're like, yes, it declines nominally, but your purchasing power, you're still able to buy more stuff. That's not why you buy gold in deflation. If that was the case, you would want to just leave cash in the bank and have interest income. That way you get money nominally, and then you can buy even more stuff than when you buy gold. The reason why is during deflation, banks fail, assets fail, bonds fail, debt gets deleveraged. So you may have interest income from a bank which loans out that money in existence. Well, that customer of the bank defaults. It defaults on the debt. The bank goes out of business, and your cash is gone. It vanishes, smokes, goes up in smokes. What's great about gold during deflation is there's no counterparty risk. That's what it is. During deflation, there's debt deleveraging, and equities go to bust because companies go out of bankrupt. Common equity is no longer valued it's valued at zero. Banks go bust, they go value at zero. And that's why I always say, in my opinion, I'm not telling you what to do, I'm not giving financial investment advice, but my opinion, 10% of your assets should be in physical gold, not including silver, not including platinum, not including everything else, because there's no counterparty risk. There's none. You don't have to worry about, like, homes are not they're physical assets, but they're not, no counterparty risk. You have property taxes, you have to pay them. You can't pay them, you have to sell the home. So in my opinion, now based on this new light of information I was thinking about with gold and thing is, I think after this next run up, which is coming, where they're manipulating psychology and interest rates start to spike and there's nothing they can do, I think the best portfolio would be, depending on your net wealth. If you have a very high net wealth, you might not be able to do this. But in my opinion, 10% physical gold, 5% physical silver, 5% in the platinum groups, metals, and 20% in just cold hard physical cash, meaning you get a safe and you put it in there. It's not in the bank. And I mean, if someone had $100,000 in assets, that might be a good outside the system portfolio, because I think there'll be deflation. I don't think the dollar's going away. And you can put 20% in physical metals in a safe, have separate safes for cash. This is something I'm going to start exploring. I'm not saying exactly, there are risks, non-banking, non-financial, such as you get broken into, you get robbed. So, if you have family, you might want to keep them in different places. So if you have people you can trust, like family you can trust, maybe some where you live, some where, your parents live, or maybe even, I wouldn't do siblings if they live different, but so it all depends on, your personal situation. So that might not work for you. So that's why I don't give financial advice, and I'm not licensed to. It's just I'm thinking out loud about what I do. So yeah, there's no counterparty risk. And one other thing I want to do is I want to revisit Cyprus. And I think this is coming to the US this decade. And what happened is anyone that had 10,000 or more had bank balance. And then what they did was they issued equity in a bankrupt bank to make up for it. Of course, there was no dividend, they were bankrupt and whatnot. So that could happen in the US, and that's why I like gold. Let's say gold goes from 30 to 25,000. Well, right now it's 2,000. Let's say this happens, people have to deleverage. Gold goes from 2,000 to, in a Cyprus situation, maybe 18,000, or 2,000 to 1,800. Well, you're still not going to have a 50, 60, or 70% balance. So you are saving money. You do have, there's no counterparty risk. And you do what? And so you don't lose that much. Yeah, losing going from 2000 to 1800 stinks, but you own equities, you go to zero. You own the banks, or someone defaults on a debt, you don't have any income. And that's the real reason gold is a good deflation hedge. It has no counterparty risk. And I think when the commercial real estate bubble starts bursting, the housing bubble starts bursting, when, among others, there's a commercial real estate, auto loans, credit card banks, technology, that's a bubble that's going to burst. When these bubbles, and that's five. Think of how bad just the housing in '08 and tech in 2000. We have about 5 or 6 bubbles. When those, and that's why I think gold will is a good thing to have, even if it doesn't do anything or only loses a little, is there's no counterparty risk. You don't have, you can buy housing, but you have to rent it out. And if the person you're renting to loses their job, you don't have any cash flow anymore. Then you lose the equity because the housing market crashes, and you still have a mortgage, or you still have whatnot. So you don't have even, some people don't even have the equity. So that's why I like gold. You buy it with cash. You don't buy in credit. And yeah, in my opinion, also, a lot of people, they should do what they can do. Make sure to get your car payments, your housing payments. Do what you can to get out of debt, even if you have to take on a second job, or do what you can to try to become self-sufficient and not depend on your job. That's what I'm doing right now. I'm trying to do more of that. But anyway, that's all I have to say. I just want to revise a lot of things. And I'll post the article of the Labor Department higher interest rate below. You can read it if you want. And I hope you like this video. If you liked it, please, especially if you watch all the way through, hit that like button and subscribe if you haven't. And I will see you next video.